Hello, and welcome to Let's Talk Tax, the show for growth-minded CPAs and real estate pros in tax. I'm TJ Sponsel. In today's episode, we'll dive into the ongoing uncertainty surrounding Section 174, exploring its impact on CPAs and the R&D Tax Credit, and why taking proactive steps now is essential as legislation clarity remains elusive. Returning to Let's Talk Tax is David Seibel. David is a principal in the McGuire Sponsel's R&D Tax Credit service practice, specializing in IRS regulations and audit defense. Welcome, David.
Thanks for having me back, TJ.
Well, David, we've been living with 174 for a long, long time, and kind of the ongoing, not joke, it's not a joke by any means, but always is interesting is that when we talk to a client or an alliance firm, there's usually about a 5 to 15 minute window of time before 174 comes up anytime we talk about the R&D tax credit. So,
right,
and thinking about this important subject, I thought today we could focus on some things on 174, what we know now, and then maybe dive into some of the 24 compliance for the 67, 65, and the other issues that you see facing the R&D tax credit. Okay?
Sure.
So obviously we're sitting here, we know the Senate didn't pass the tax bill. What's your looking at in terms of where HR 7024 was, and basically essentially is dead now. Unfortunately, we've known that for some time. What do you see? You see anything happening for the balance of the year regarding this bill?
No, unfortunately not. I mean, there could possibly be a lame duck session, but, based on comments from the House and Senate, it seems like 174 compliance for amortization is here to stay for the 2023 tax year, which obviously sets us up for potentially something in 2024. But for all intents and purposes, it looks like the 23 tax year is going to be similar to the 22 tax year where 174 amortization is here to stay.
From what I've read, David, and probably the same thing you've read, is that I just think the ultimate kind of the kiss of death was the expansion of child tax credits. And I think for some Senate Republicans, making it the 174 repeal reactive back to 22 just drove the cost of the bill up too high.
Yeah, I mean, that cost seemed to be at least a factor that they publicly said was the issue. So, that maybe sets up for possibilities going forward of, what it might look like when they're arguing for, these new potential other tax legislation, that's, again, getting set up for 24, maybe even possibly for 25.
Yeah, I really think this is complete speculation on my part. I have no insight in master intel here, but obviously nothing's going to happen in 2024, I don't believe. And I think in 25, hopefully, if we can deal with it soon enough, and that's a strong if, maybe 24 can be brought into it just because of the nature of the filing. But one thing I want to focus on, Sly, is, I'm sorry, I call you David. Sly is his nickname around the office, everybody, so I apologize to all our listeners. Sly is David Seibel. And but one thing that I wanted to know is to get your thoughts on, and I think it's important for our listeners to understand, is I think in 2022 tax year, meaning in 23 calendar year, I think a lot of firms, and we all had hoped that this was going to get fixed. So they really didn't pay attention to 174. They didn't take it seriously. They didn't know that the guidance didn't come out till September of 2023.
Right.
And they're sitting there going, okay, I'm not going to take this too seriously because the IRS hasn't even come out with guidance, or they just avoided it. They didn't even take the credit. They didn't take 174. Then they get the calendar flips to 2024. They haven't done the 23 because HR 7024 is out there. It's going to get fixed. It's going to repeal the 2022. Well, now what we're seeing is that we're 2/3 of the way through 2024. It's here for the 22 year. It's here for the 23 year. It looks like it's going to be here for the 24 year. And the way the Republicans are talking in D.C., it's not going to get fixed until 2025. Walk us through the steps in terms of what, if they want to go back and correct now. If you're a company that goes, okay, wait, I got to take this seriously. How do they correct it? How do they go back, and what's the steps they have to do to get their clients in compliance with 174 for the 22 and 23 tax years?
Assuming they already filed their 23 return, the next step would be looking to 24 and capturing the 22 and 23 174 expenses using a 3115 change of accounting method adjustment. The guidance that has come out from the IRS indicate that this is considered a change of accounting, and they outline the steps for doing that for 3115. That unfortunately means a pretty sizable positive 481A adjustment that would need to be done in the 24 year to account for those 22 and 23 changes. But there is the possibility that you're able to spread that hit out over 4 years, including that 24 year. So even though it would be, a heavy burden for the next couple of years, there's still the possibility that, you don't have to necessarily take all of that hit in the 24 year.
Now, they would go back and still amend the 22 and 23 to claim the credits. They would just do the 3115 on the 24 tax return, correct?
Correct, yeah. So the 3115 would just be specifically for 174 compliance. And then if, to your point, if they just completely ignored it, or you had some clients that said, oh, well, because we don't take the credit, we don't have to amortize, and all those positions that we've seen some people propose, yes, you would have to go back and amend the 22 and 23 returns to actually claim the credits. Then you would utilize them however you can, carry them back, carry them forward, with the potential that, if you were in a, neutral position, that you could carry forward those 22 and 23 credits to help offset some of that added income that you would be faced with in 24.
Yeah, and I think that's the great unknown, is how is the IRS going to look at this?
Mm-hmm.
And we just got alerted here recently that one of our clients got their taxes, their 21 tax returns getting pulled for audit, and they also brought the 22 in, and unfortunately, the CPA and the client did not claim 174 in that 22 years. So it's going to be really interesting as that proceeds through audit of where that's caught, because in 21 they did have an R&D credit. So they've clearly said they have 174.
Sure. And
now in 22, the IRS is going to look at that. So I think that's the great unknown we have in terms of advising the entire risk. What's the risk on that? What's it going to look like, and how do we navigate through that? But I've been surprised, even though I shouldn't be, is that now that Senate bill didn't pass. I mean, just in the first week after that, I think I had about a half a dozen calls with clients and CPAs going, okay, how do I correct this? And it's almost like, in a weird way, the bluff was called, and they know it now. And okay, how do we fix this?
Yeah, there's still the opportunity to still file a 3115 for the 23 year,
Sure.
if that's still active. If you're maybe a fiscal year end filer, and you haven't filed your 23 returns yet, there's still the possibility to correct that using the 3115 for the 23 return, and start to right the ship, so that, to your point, you don't run into compliance issues if, God forbid, your 22 return gets pulled in and you didn't do anything for 174. So there's still the possibility there. It's just probably most of the taxpayers out there are the 915, 1015 calendar year taxpayers, and we'll have to look toward 2024 to be able to capture everything that they should have captured on the 22 and 23 returns.
Sure. I think with the R&D credit, specifically since 1/1 of 23, when we found out that this was not going to get fixed, or it was not, the fix was uncertain at best, I think 174 is taking up a lot of the oxygen around the R&D tax credit. However, the R&D tax credit remains one of the grayest areas of tax law. And so the 24 tax year brings a new step for taxpayers of a certain type in terms of how they are going, what's going to be required when they file that 6765. We've talked about it as a firm. Obviously, now looking in Q4 of 24, with the filing season just around the corner. Can you kind of give us an overview of what that compliance looked like, some of the safe harbor provisions of what these taxpayers are going to have to report on their 6765 that they may have never had to report before? Yeah.
So earlier in the year, the IRS put forth a draft of what the proposed changes to claiming the credit would look like for 24. Very, very heavy on listing out pretty much the entire 4-part test, exclusions, how a company would qualify for each specific business component. Just particularly very onerous for companies that either have relatively small credits, which we know how valuable those credits are to those small and medium-sized businesses, or it's just so onerous for those large companies that have maybe thousands and thousands of projects that they do per year. So it looked like it was really going to be an uphill battle on trying to even just fill out the tax form to be able to claim the credit. Luckily, the IRS took the feedback that was proposed, incorporated some changes, and so now it's a little bit more simplified. It's, you still have the traditional information that you have to fill out for the 6765. A few additional questions that weren't present before, such as if officer wages were included, or if you acquired or disposed of any major trades or businesses during the year. And then for this year, it's optional that you can fill out the Section G, which is related to the business components, how things are qualified, what are the business components, what were the research activities performed. That's optional for everybody, no matter what the size of the company is. And then going forward and starting in 2025, for tax years 2025, there's some safe harbors, as you mentioned. If you're electing the payroll tax credit offset, or you have 1.5 million in QREs and under, and also are 50 million in revenue and under, that section is optional. Not to say that you wouldn't have to provide that in an exam situation. It's just not required to be filed on the originally filed return. And then if you do go back and amend, Section G is required as well.
Well, and that was a huge relief for us, because I think you have clients that it was going to require a lot more compliance. I mean, not necessarily they have the documentation to already support their credit, but for us to be able to prepare those, we call them memo statements. It goes back to what came out a couple of years ago for amended returns. But it's additional time in the engagement. It's additional burden on the taxpayer when they're already facing enough burden. So I think that was a welcome news when those provisions came out.
Yeah, you came from a tax form that maybe takes 15 minutes to fill out to now potentially a tax form that takes, could take an hour or so to even fill out, much less the work required beforehand to even get it to a spot where you can put it onto the tax form. So definitely a welcome change that it's going to be optional for those smaller taxpayers.
Jumping back to 174, I think, over the years, we have been able to serve hundreds, thousands actually of companies over the years. And now that, such a big piece of what we do with R&D practice involves 174. I feel like we've done a really good job of helping our clients know the documentation for 41 credits. We've completed our second year of 174 analysis for these companies, knowing how punitive 174 is. What tips do you have, from a documentation standpoint of 174, to make getting their arms around that, or our arms around their expenses, easier going forward?
Yeah, it's still, obviously, if you're claiming the 41 credit, it makes 174 compliance a whole lot easier. But, we have definitely seen some areas that are a little bit trickier to document, particularly for those areas that are outside of traditional 41, like, some things that would be subject to the funded research exclusion, but they're considered 174 costs, like for contract research, for instance, where you have, maybe a company that's conducting research for you. You're not able to include it in the 41 credit, but then you have to still amortize those costs. So just being a little bit more proactive during the year and trying to figure out, okay, is this, maybe, for example, a contractor, is this a 41 eligible expense? Is it a 174 eligible expense? Same thing with the types of projects that are being conducted, because we've also seen, again, certain projects are being conducted that are not considered 41 eligible because of the funded research exclusion, but then the company, the taxpayer, still has to amortize it because they either own the research rights, or or they have that financial risk, since it's an situation or test for the 174. So just being a little bit more proactive on that, documenting those types of things, I think goes a really long way in trying to, make it more contemporaneous throughout the year.
And we've seen that a lot. I think one industry that's been really impacted by that is architectural firms. We're fortunate to serve a lot of them over the years, and that's something that really came in because there was a lot of standard language when they subbed that out. And just for listeners that aren't familiar with the term funded research is something we've talked a lot about with the 41 credit, because with funded research, as a taxpayer, if you're getting paid on a project, payment to you by your customer is contingent upon your success. That's when they bear the economic risk, as well as they maintain rights to the technical knowledge that's being gained during that project. So with the 41, when you have funded research, is a bad thing, because that means you're not bearing the economic risk, or you don't own the research. When you don't have funded research, that's good for the credit, because payment to you is contingent upon your success, so you have economic risk. and you have rights, even maybe a shared right, to the technical knowledge being gained or the project. Okay, it's an and.
Yep.
Just to clarify your point. On a 174, economic risk and substantial rights to the research are an or situation. So you may not. So that's when David sits there and says it's eligible for the 41, but or it's not eligible for 41, but it's eligible for 174, is because it didn't get the and on 41, but it hit the or on 174.
Yeah, and that can be particularly onerous for a lot of different taxpayers that are for sure in that or situation where, maybe they are conducting the research on a time material basis, but they retain the research rights, or they don't retain any of the research rights, but they're still at financial risk for that research. So, and to your point, those would be instances where they have to still amortize those costs, but they're not 41 eligible and can't, have that additional benefit to help offset those 174 costs. So particularly pretty punitive for those types of taxpayers.
David, what would you say, we've been doing this a long time, and we've had clients that have been with us for a long time, and we've been to work with them and serve them and assist their CPAs. What would you say you still a couple things that trip up companies and limits their ability to claim the R&D credit?
I would say probably the biggest one is just documentation and understanding, as you're going through what is needed to document for the research credit. So just making sure that you can prove all 4 parts of the 4-part test, and do so contemporaneously too. And just remembering, documenting the projects that were conducted throughout the year, so you're able to capture the expenses that, again, are going to have to be classified as 174, no other way, but that, at the end of the year, you can still make sure that you're able to capture it as a 41 expense.
When you say documentation, just want a clarification, because a lot of times the challenges of the project will be documented in the statement of work or the drawings or whatever else. But I think would it be safe to say when you say documentation, it's demonstrating an individual's involvement in that project? Correct. A lot of times we can explain why the project meets all 4-part criteria. What we struggle with is making sure there's that nexus between the project and the expense, meaning the person or the material or third-party costs that we're trying to claim as a qualified research expenditure.
That's exactly correct. It's truly is the nexus between the projects, which often are relatively straightforward exercise to determine if they're qualified or not under 41, but then establishing those people to projects, particularly if there's no time tracking system in place, particularly for those people who may not necessarily have the right title. So those officers and maybe presidents of small to medium-sized companies that were engineers and are still very much involved in the engineering process, being able to tie their time to those projects, whether that's through email correspondence, sketches with their names on them, meeting notes, just again, something that you're able to tie those people to those projects. Like I said, particularly for those people who may not have that correct title, particularly because as one of the questions on the new 6765 is what are the amount of wages from officers that are counted as wage QREs. So being able to answer that question truthfully, because sometimes those officers are those more highly compensated individuals and might make up a greater share of the percentage of QREs, making sure that you just have the processes in place to be able to capture their involvement in those qualified projects.
One last question for you, and I'm gonna go rogue a little bit on you, David.
Okay.
Is that with what we're seeing with clients and certain CPAs, they're kind of taking the different position. Okay, this was qualified research in 21 and prior, and then now we've changed to this is qualified research, mainly because of 174 purposes in 22, 23, and 24. Obviously this is incremental credit, meaning we've got to establish this base amount. We're comparing this tax year versus the prior 3 years if you're using alternative simplified. Walk us through the consistency rule and how the IRS looks at that.
Yeah, so the consistency rule basically says the expenses that you capture on the current year, you have to be consistent and with those base years. So technically, if you're, you have to be consistent from year to year. You just can't pick and choose what expenses are qualified and not qualified from one year to the next to artificially increase or decrease that base. So, while we appreciate that the position companies are in, and for those clients that are trying to bring down their 41 number, we do have to advise on that consistency rule. If it's a matter of just cutting out a few people here or there, maybe that's not the worst thing. If just evaluating who might be, truly involved in research, or seeing who they can, again, which places they can cut out. But if you have a company that goes all of a sudden from $1 million or $2 million of QREs down to 500,000, again, one, you're not going to generate a credit just because your bases were larger back then, but also it does, from a consistency standpoint, seem to throw up a red flag where all of a sudden, when it was good, 174, you could fully deduct those expenses. You had all these costs. Now that there's more, it's more punitive. There's less amounts that, any IRS agent, if they're examining a 21 and 22 claim, they're going to look at and see, well, what changed here, and pit those two against each other, and can probably put a taxpayer in a pretty difficult position to pick and choose which way they're going to defend it.
Well, David, thank you so much for sharing your insight and your expertise with us today. As always, if our listeners have any questions about the R&D Credit 174, do not hesitate to reach out to David or anybody else in our firm, and we want to be there to be a resource to you all. So, David, thanks again for joining us today.
Thanks for having me, TJ.
Thanks for tuning in today. Remember to subscribe to Let's Talk Tax podcast channel on YouTube so you can be notified and receive all new episodes.